Good afternoon and welcome to today's webinar, Retirement Tax Strategies for RIAs. My name is Lauren LaFerla and I'm the Director of Communications here at Covisum. I'm joined today by our speaker, Joe Elsasser. Joe's a certified financial planner and the founder and president of Covisum. Under his leadership, Covisum has developed a variety of groundbreaking financial planning tools, including Social Security Timing, which was the first patented Social Security optimizer, Tax Clarity, Smart Risk, and Income Insight. Joe co-authored Social Security Essentials, Smart Ways to Boost Your Retirement Income, and is a regular contributor for USA Today, Investment News, CNBC, The Street, and Think Advisor. Joe also maintains a financial planning practice in Omaha, Nebraska, doing the very things he'll talk about today. Our topic today is retirement tax strategies for RIAs. You will see a box labeled questions. If you have a question, please type it in the box and we'll get to your questions at the end of the presentation. A reminder, we will be recording today's presentation, so be on the lookout for today's recording in your inbox later today, and I'll turn it over to Joe.
Thanks so much, Lauren, and thanks to everybody who has attended today. Fun topic. You know, this is I suppose for those of us who are kind of nerdy, and I say that with all the appreciation for my fellow kind of nerdy advisors out there. So today we're going to dig into tax strategies for RIAs. And my expectation is these are all things you've probably heard of, but my hope is that through the course of the presentation, we can contextualize them in a little bit different way than maybe you've seen in the past, for one. And for two, I suppose my second hope is that you'll be able to communicate them a little more effectively so that you can show clients the impact of the things that you're doing for them. So of course, first, we'll start with some disclosures. Advisor use only, and I'm not with Social Security Administration, not with the IRS, all that jazz. So there we go. There's the disclosures, they're out of the way. And here's the agenda for today. This entire presentation is focused around clients who are in retirement transition and beyond. Now, if you've been involved with Social Security planning, you know that Social Security gets really interesting taxation. We're going to start there because we're going to build around it some of these other tax strategies. I think you're going to find that really effective. We'll talk about how to spot opportunities, and then we'll talk about specific techniques with IRAs and with your non-qualified or taxable accounts. But before we get started, the why should be super clear, but this is a recent survey that was done by Orion, actually, where what they found was that 80% of investors believe that advisors should focus on minimizing their tax obligations. And of course, in any year where you've got significant tax happenings, if you will. Last year, I just read an article that last year the IRS had a ridiculous amount of extra revenue compared to what they had projected, primarily because of all the capital gains that people harvested, a lot of short-term capital gains. Realistically, it's probably those situations where people, had needed to pocket some of the profits of the recovery. So I know we had more short-term capital gains in our practice than we have in many years. So important to clients, I think, is what we take away from that. Let's start off with just a quick poll. What tax techniques have you used in your own practice in the past? Lauren, can we launch that? Awesome, a huge number of people doing Roth conversions. That is way, way better than the general population of advisors. That's exciting. And I would expect net unrealized appreciation to be one of those techniques that comes in near the bottom, primarily because if you're not working with clients that are that have company stock, then you're probably not doing that very often. That's a once in a while thing for us in our practice. Let's go ahead and move on to the presentation. All right. Get that out of the way. There we go. Okay, so let's start with Social Security taxation. This will probably be a recap for many of you, but there's always the few people that it really helps to zero in on the few steps that are in the Social Security taxation process. The first step is what we call provisional income. And what's really, really important is that only 50% of the total Social Security benefit is calculated in this provisional income calculation. So only 50% is included in the provisional income calculation. Then we add in ordinary income, IRA withdrawals, wages, etc. We add in any dividends and capital gains, and we add in non-taxable interest. At that point, we apply a set of benefit tax thresholds, and only the dollars that are over those thresholds become taxable Social Security benefits. So if I'm at $32,001 and I'm a married couple, it's not that the entire $32,000 of provisional income becomes taxable. I end up with 50 cents of taxable Social Security benefit. Only the amount over the threshold is multiplied by the inclusion amount. So 50 cents on the dollar for over 32,000, 85 cents on the dollar for dollars that fall over 44,000. So here's the example. If I had a $40,000 Social Security benefit and a $20,000 IRA withdrawal, I take half my Social Security benefit, so that gives me 20 grand. I add that to the 20 grand of IRA withdrawal, and I get 40,000 of provisional income. I subtract out the first threshold. I'm 8,000 over the first threshold, $4,000 of taxable Social Security benefit, and I'm not over the second threshold. So my total taxable benefit is $4,000. It's only 10%. This is a couple that has $60,000 of Social Security benefits coming into the household. $36,000 gets left behind in the instructions for the 1040. I know nobody fills out paper 1040s anymore, but that's the funny part about this calculation. It doesn't even live on the 1040. In order to figure out how much taxable Social Security benefit you actually have to jump off to a worksheet that is held in the instructions. It's no wonder people think, gosh, I have $44,001, 85 cents of every dollar of Social Security is taxable. It's just not the case. If we look at a second example, though, 20,000 of Social Security with $40,000 of IRA withdrawal, we end up with 50 grand of provisional income. Again, half the Social Security plus the IRA withdrawal. We end up $9,000 over the first threshold. We end up $6,000 over the second threshold for an $11,100 taxable benefit. It's 55%. So we've got 60 grand coming into the household in both situations. We've got a dramatically different tax result because of the composition of the total income. So when we bring it onto the return, this gets really interesting as well. We bring it onto the return, we've got 40,000 of IRA and 20K of Social Security. We've got 11,100 of taxable Social Security plus the IRA withdrawal. Gives us total taxable income of 51,100, but then we subtract out the standard deduction. And this is for married filing jointly, both 65 plus. And we end up with taxable income of $22,400 for a $2,277 tax bill. So that's the first example. Now, in the second example, where we have the opposite mix, we've got a much larger Social Security benefit and a smaller IRA withdrawal needed to meet the total income need, we end up with a really different picture. We actually end up negative when we subtract our standard deduction from our total taxable income. We actually end up negative. Of course, you're not going to get that money refunded to you, but really it's wasted deduction. They would have the ability to take out a little extra out of the IRA and still pay no federal income tax under that second scenario. So I go through the taxation of Social Security benefits first because the vast majority, 90+% of retirees are going to have some Social Security benefit on their tax return. Now, from there, let's talk about how to spot tax opportunities. And it's as important for you to be able to spot them as it is for you to be able to help your clients visualize those tax opportunities. And in order to get there, we've got to talk a little bit about our tax system. Of course, everybody on the call knows that we live in a progressive tax system, a system of brackets. As I go up in taxable income, the dollars that fall into that next bracket get taxed at that rate. And of course, it's only those dollars that get taxed at that rate. So this is the way that you've probably seen us represent it. We call it a tax map. We began doing this actually in an Excel spreadsheet in my own practice, probably over a decade ago now, and clients just got it. And so the idea here is, as I move to the right across the bottom, I'm adding ordinary income. You can think I'm adding IRA withdrawals, or I'm adding bond interest, or what have you. And what it does is it tells me how much I'm going to pay on that next dollar. So the idea here, up to about 28,000 and change, I'm really experiencing a 0% tax bracket. Why is that? That's the impact of deductions. And then after that, I experience 12. And then once I hit this point, I jump up to 22, but only on those dollars that fall in this range. So that's how we read the tax map. It's how we can help clients visualize the tax situation. Now, for most of us, if we ask our clients, hey, and by the way, what rate do capital gains get taxed at? That's a favorite seminar question for me. Oh yeah, and what's the rate on capital gains? Now, capital gains actually follow a similar progressive system. If someone has taxable income between 0 and 83,350 plus any standard deduction, and that's the only thing they have, they'll actually fall into a 0% capital gains bracket. Most people are going to be experiencing a 15% capital gains bracket, and higher wage earners are going to be experiencing a 20% capital gains bracket. So we can map that out really in the same way that we mapped out our ordinary income brackets. And again, you notice the capital gains brackets are shifted over to the right based on the inclusion of that standard deduction. So this is a concept, though, that most people, most clients really do not understand. And that is that there is an interaction between ordinary income and capital gains. And I really want to talk about this today because it's going to influence some of the strategies that we talk about, some of the techniques we talk about later. So when we add that capital gains bracket, the 0% bracket, up to 83,000 and change, and we add the standard deduction, we actually get about 112,050 bucks that someone can have if they only had capital gains on their return and still pay 0 federal income tax. So here's the first example. If I just had 100 grand of capital gains and that was it, nothing else on the tax return, that's all going to come through tax-free. It's all going to come through tax-free because it'll all fall in the 0% bracket. But now let's say I have the $100,000 of capital gains, but I also have 50 grand of ordinary income. So in that case, 25 grand of ordinary income. And so 28,000 of ordinary income, my apologies. So I'm going to end up in this case with $28,000 of non-taxable ordinary income because I'm under the standard deduction. But what's actually going to happen is it's going to push the capital gains up over the line. So ordinary income stacks under the capital gains. And that's what happens here. It pushes some of those capital gains out of a 0% capital gains bracket and into a 15% capital gains bracket. Now, the same thing over here, let's say that instead of just 28,000 of ordinary income, I had a situation where I actually had 50 grand of ordinary income. So the first 28.7 would be eaten up by the standard deduction. Then the next 21.3 would fall into the taxable range for ordinary income. So that's going to end up being taxable at the bracket rate. Part of it's going to come through at the 10, and a little bit's going to come through at the 12% bracket. But now all of that ordinary income has pushed a much larger chunk of capital gains above that line. And so now I've got $37,950 of taxable capital gains. So hopefully that gives you an idea of how ordinary income can increase capital gains. There is an interaction there that we really want to pay attention to because it can matter a lot when we're working with clients on these tax planning strategies. We also want to keep in mind the Medicare premium surcharges. Now, of course, this isn't a tax and it doesn't apply this year. It applies 2 years later. But keeping these thresholds in mind is really important because that increase is applied for $1 over. It's not like tax brackets where only the dollars that fall over get taxed at the new rate. We get this entire penalty the minute we go $1 over the threshold. And so if you've ever seen those represented in Tax Clarity, they're represented as spikes. And the last one we pay a lot of attention to on these techniques is the 3.8% net investment income tax. Now, oftentimes you'll hear middle and upper wage earners referring to capital gains rates of 18.8 or 23.8. And really that's just the 15% capital gains bracket or the 20% capital gains bracket, plus the additional net investment income tax that applies to people who have adjusted gross income over the thresholds, 200 for a single, 250 for a married couple, and it applies only to the net investment income items listed over on the right-hand side. So really what we want to be thinking about when we think about tax planning is the concept of the effective marginal rate. And that is, when I do something, how much of that action, how much of an impact does that action have on my tax return or on what I owe? Might be the easy way to think about it. How much of your last dollar will go to pay Uncle Sam is the real question we should be asking for any financial planning decision. Now let's bring some of these things together. This is a married couple, 65 plus, $61,000 of combined Social Security, 10 grand of net long-term capital gains, and 52,000 of IRA withdrawals. Here's what they experience on up to about the first $10,000. They actually of IRA withdrawals, they actually experience a 0% impact. And that's because it's being eaten up by the standard deduction. But once they get over about 10 grand of IRA withdrawals, they're actually experiencing an 18.6% effective marginal rate. Now, if you hand calculate it, it's 18.5, but the way the IRS does tax brackets, they round up and round down in $50 increments. So when you calculate it out, you get 18.6. So that is $1 of IRA withdrawal that is dragging in 85 cents of a Social Security dollar that are both being taxed at the 10% marginal rate. So the effective marginal rate is 18.6%, because if I didn't take that dollar, I wouldn't pay the 18.6 cents to Uncle Sam. Then we jump up to 22.2, same concept, dollar of IRA drags in 85 cents of the Social Security benefit, both getting taxed at the 12% bracket. We jump up to the 49.95. I had a client in a seminar that said, now, okay, explain the finger again to me. And I had never thought of it like that, but now I can't get it out of my head. The finger there is a 49.95% effective marginal rate. You may have heard that referred to as the tax torpedo. And here's what happens. Intuitively, if we trace that down, that 49.95 falls in the 12% bracket. So intuitively, we would expect that a $1,000 IRA withdrawal would fall into the 12% bracket and create $120 of ordinary income tax. But instead, what happens? Yes, that happens. But it also creates $850 of taxable Social Security. And if we remember how capital gains are stacked on top of ordinary income, so taxable Social Security is taxed as ordinary income. So now what we've also done is created an additional $1,850 of capital gains that would have fallen into a 0% bracket. We've pushed them up into the 15% bracket, creating an additional $277.50 in tax. So the total additional tax burden on that $1,000 withdrawal is actually $499.50. That's the 49.95% effective marginal rate, or the tax torpedo, if you've heard it referred to as that. We have a similar situation that can occur with capital gains. Because this particular client had 61,000 of Social Security, and they also had 50,000 of IRA withdrawals, 52,000, I think, the very first dollar that they harvest in capital gains is going to create 10.3% effective marginal rate. And that seems really, really weird. How could that be? We have a 0% rate and we have a 15% rate. But what's happening is when we harvest that first dollar of capital gains, we're actually getting 85, we're getting a portion of that dollar, 85% of that dollar is being pushed up into taxable range. We have the same thing with the 38%, where our capital gain dollar creates taxable Social Security, which then in turn goes back under the bridge and pushes the more capital gain back up into taxable capital gains range. That's where we experience a 38% effective marginal rate on capital gains. Now, once we've gotten through all that taxable Social Security, we drop right back down to the 15%, and we wouldn't see a higher rate until we get out here with net investment income tax, basically off the chart to the right, and we'd see 18.8% next. So that's the real tax system for capital gains. Now, when we think about spotting opportunities for tax planning, really what we're looking for are situations where the effective marginal rate that the client is going to experience on the next dollar, either to the right, meaning by adding more dollars, or to the left, meaning by doing things like an IRA contribution or stopping a withdrawal from a retirement account and using other dollars. Whenever that effective marginal rate is really different than what the client will average over their lifetime, that's an opportunity. That's what we really want to be looking for, are these opportunities where what we can do right now is really different than the average that they'll experience throughout the course of their lifetime. Now, let's drop into this next section. This next section is IRA opportunities. Where do we spot these opportunities related to IRAs? And we'll start with a couple case study. So we've got John. He's born in 1958. Primary insurance amount, I do that for Social Security, of $2,700. So that means his Social Security benefit at his full retirement age is going to be $2,700. And we're planning for a life expectancy of 87 for him. For Jane, we're planning for 91. And we've got her born in 1961 with a primary insurance amount of $1,800. So she's still an upper middle wage earner, and he's near the top. John's got $1 million IRA. They've got a $500,000 taxable account with about $100,000 of growth. If we were this time last year, it probably would have been a little more growth. Jane's got $500,000 IRA. They need $8,000 a month while both are alive and $7,000 per month after the first death. Oh, and by the way, we did everything in a 60-40 stock to bond portfolio just because in reality, this isn't how you'll do it in your practice, but we didn't want any rebalancing or reallocation to impact the results of these case studies at all. So if you've heard us talk about retirement income, we tend to talk in terms of three primary metrics. The first is, how long does the money last? Does the money last as long as the clients do? So in this case, our need is 30 years for these clients. That's our base case. Our income floor is what percentage of that income need continues to be met if we run out of gas with the portfolio. In other words, if we deplete the portfolio, what percentage of the client's income need is met by guaranteed income sources like Social Security or pensions or annuities? And then finally, if we do make it through retirement, what is the estate value? What's left over that is in present value, net of taxes, for the people or causes we care about? And so in this case, this client is just fine. We also throw some stress tests at it, but this client is just fine. They're likely to leave behind $1 million, and regardless of which particular stressor is applied to their situation, they're still not running out of money. So they're going to meet their income need and leave behind an estate value of about $1 million, and that's in present value after taxes. And you can see in the account balances down here, it's about $4 million in future value and before taxes. Now, that's why we focus on this estate value. I'm really going to focus in here as we do this case study. Now, this is the tax map for the very first year under the base case. So this is 2022. What you'll notice here is they have $9,762 of ordinary income coming in. And why is that? Well, that's the 40% of their portfolio, their of their overall portfolio that spits off bond interest. And so this is bond yield for this year, effectively. And then we start to see a tax situation where they'd start experiencing about a 10% rate really pretty shortly here. And then you see it jump all the way up to 27% there. So Do you see an opportunity for a Roth conversion here? Throughout the client's lifetime, they're likely to be around a 20% rate. In this case, we might really look to do a Roth conversion just to here, just to fill up these abnormally low rates that are happening for them right now. But we don't really want to go up to here, because in order to do a larger Roth conversion, we've got to go through this valley where we're paying capital gains tax on top, stacked on top of ordinary income. So let's take a pause there and do a quick poll. Do you use software for tax planning today? Looks like we've got a pretty good split here. So we've got a yes with most clients, yes occasionally, and some no. So awesome. We'll close that one down. All right. So as I mentioned earlier, we would suggest really starting with the Social Security strategy. You've seen this from Covisum really since inception, since before we were known as Covisum 10 years ago, when we were the first patented Social Security optimizer. Our suggestion was always start with the Social Security strategy. And why? Well, Social Security strategies by themselves add significant value to client lives. In this case, it's about $129,000 difference between just claiming early and following a strategy. And what is the strategy for them? Well, he's going to delay till 70. It's going to bump his benefit way up. She's going to take it 68. It's going to bump her check up pretty significantly. But what's important about a Social Security strategy, in addition to the strategy itself, it's that we often end up creating a gap between the point the client actually stops working and we no longer have ordinary income that has to be on the return, and the point where they take their Social Security benefit. So we have this window somewhere between, a few years all the way out to 8-9 years, where we have ultimate tax flexibility. We have the ability to pick and choose which income streams we're going to use at which points. And when we can clear Social Security out of the picture, we end up with oftentimes a little bit better opportunity for things like Roth conversions. So let's bring that Social Security strategy into the plan. Now, of course, when we do an analysis for Social Security only purposes, we're going to treat Social Security as though it is a bond, and we're going to discount it like it's a bond. But when we bring it into the plan, oftentimes it's just part of the big picture, which means that we end up comparing equity returns to Social Security returns in some ways. And so you'll often see when it's just a Social Security strategy, the estate value doesn't jump up quite as much as it does when you evaluate Social Security in a vacuum. And the reason is because you're spending equities in order to delay the Social Security benefit or some portion. And of course, over time, it's likely, but it's not certain, that equities may outperform. And so that's why you see an increase in the estate value that's not quite the amount that we identified when we did the Social Security strategy, but it is significantly net positive. Now, when I pull up the tax map, I see a little difference in the Roth conversion opportunity. So if both were claiming early, we would have had some Social Security on the return in this year. But instead, if I'm following a Social Security strategy, I actually have a significantly larger Roth conversion opportunity. I don't have this whole gray block here with 10%. I can go all the way out to the point where we hit 25 and then 27, and I can do my conversion all the way up to that point. So it creates some additional opportunity to do Roth conversions, especially early on. And this is what that would look like. So we would go all the way over rather than the 9,000 and change that has to be there. That's the bond interest flying off the portfolio. Instead, we're going to go up to right about $43,000. And we're going to get right to the edge of where they start paying 25%. We're going to take advantage of the 0%, take advantage of the 10, and we stop when that next dollar is going to get us to 25. So this is what those conversions would look like over the first 5 years of the plan. And you notice they're going up every year. So 33,000, 45, 64, 81, 98. what's happening there? Why would the conversions be increasing? Each year, we have less bond interest. We're spending from the non-qualified account. So each year we've got less bond interest that is likely flowing on to the return. Now, of course, it'll be interesting. We'll see how high interest rates get and what bonds do in response. But in general, conceptually, that's what we would expect. The other thing that's happening is brackets inflate every year. So we're spending down the non-qualified account. We got less bond interest hitting the plan. And we've also got a situation where brackets are increasing. And that's why you see the conversion amounts going up each year. So what are the results when we bring that Roth conversion into the plan? We actually end up with a much greater estate value. So you notice that was over $120,000 of additional estate value. That's in present value, net of taxes. So in other words, by doing those Roth conversions, we were able to add the equivalent of $100,000 plus to their plan today. That's like adding 100 grand to their balance sheet today. So oftentimes an excellent strategy to engage with clients, particularly when you can demonstrate the why. Why do we want to do this amount as opposed to some other amount? And visualizing it is what's so important about that process. Now, let's move on to the next technique. I've got this one under the qualified or the IRA techniques, but it really bridges the gap, as does the next one. So net unrealized appreciation is a situation where if you have clients who have appreciated company stock in their 401k, then we have this opportunity called net unrealized appreciation. So in this case, it's the same client situation, but we've got 500K of John's 401k is in company stock that he purchased with a total cost of $100,000. The NUA rules allow us to transfer the company stock in kind. That's super important. If you sell the company stock in the plan and just transfer the money out, you won't get this treatment. You got to transfer it out in kind to a brokerage account. And you're going to pay ordinary income tax only on the basis, not on the total value as of today. So his basis was $100,000. Pay ordinary income tax on the basis. Now, once it's in the brokerage account, the stock is going to show $100,000 of basis and it's going to show a $500,000 value. So it'll have $400,000 of embedded gain. Now, if I sell that today, I'm going to recognize that capital gain. It's going to be treated as long-term capital gain based on the point when it was purchased in the 401k. So I don't have to worry that it came out today and I sell it tomorrow. It's based on whenever I purchased it in the 401k. So 400K of embedded capital gains. Now, in most cases, the capital gain rate is going to be lower than our ordinary income rate. So here's what this might look like in the first year. So in our first year, you would pay an additional, this particular client would pay an additional tax cost of about $20,000 to get that $100,000 out of the IRA. Remember, they had some other capital gains that were on there, and that's why we've got that effective marginal rate that's up there at 27%. So what else might I want to do at the same time? If I could find a way to reduce my other capital gains that were showing up on the return, then I'd want to do that as well. Because I want to keep the return as clear as possible when I bring that additional $100,000 of ordinary income out. It's a lot like a Roth conversion. The more clear I can make it, the better. Now, the second piece of this is, when do I recognize the capital gain, right? So now I've got a situation where I had to recognize 100K of ordinary income. Probably don't want to do that while I'm working. So usually you're going to execute that first part, that roll into the brokerage account the year after the client stops working, or if they only have a little bit of income in the current year. And then I'm oftentimes, particularly for middle income client, for super high net worth, it's not going to make a heck of a lot of difference. In fact, the ordinary income rate is going to be dramatically higher than the capital gains rate. So maybe I do sell them in the same year. But for middle income clients, I might want to realize those capital gains over time. So in this case, remember, I cleared out the Social Security. And so all I have, I've got nothing on the return. So maybe in the next year, in 2023, I realize the 100K of capital gains. I'm only paying that 15% income capital gains tax on about $5 grand here. and much of it's going to fall into the 0% capital gains bracket. So that idea of stretching out NUA over a couple of years, taking the ordinary income hit in 1 year and then stretching the capital gain hit into future years can make a lot of sense, particularly in those gap years while you're delaying Social Security, you don't have a lot of other things going on the return. Those are good opportunities. Now let's talk about a couple of other capital gains opportunities. But of course, we want to remember this idea that ordinary income can increase capital gains tax. So here are 3 ways to reduce capital gains tax. First one's reduce ordinary income. Strange, right? Just talked about that. The second one is harvesting capital losses. And the third is taking advantage of a 0% capital gains bracket. And I'll dive into those in a little more depth. So here's our married couple from our case study. This time, let's assume they have $100,000 of earned income. They've got $25,000 of capital gains. So if that's the case, they're looking at about $10,800 of federal income tax. That's excluding the FICA on the ordinary income. That's just federal income tax. So what are they actually experiencing? On a portion of that, they're experiencing a 27% rate. So if you were to actually look at their tax return, what you would see is taxable capital gains that are less than the total amount of capital gains. That's important. Whenever you see that, you know that they're living somewhere in the middle of one of these anomalies. And so what we would see here is that a simple IRA contribution, they've got earned income, they can still do an IRA contribution. And a lot of CPAs are going to look at this and they're just going to say, there's no need to do an IRA contribution. They're in a 12% bracket and they're going to be in at least that when they're retired. But if you recognize that the capital gain is stacked on top of that ordinary income tax, then really by making an IRA contribution, we're saving 27%. We're saving the 12% on the ordinary income, but we're also bringing those dollars, those $14,000 of capital gains out of the 15% bracket and back down into the 0% bracket for a net savings of 27% on the IRA contribution. So that's the idea for reducing ordinary income in order to reduce capital gains. Whenever you see it stacked like this, it's a great opportunity to try to find ways to reduce the ordinary income. Another situation that we hear a lot about is harvesting capital losses. Hopefully there's some insight here that is a little bit new for you, because I've never heard of people saying, be careful how much loss you harvest, right? Let's say that I have this $25,000 of capital gains. This is the case we just looked at, 100K of earned income, $14,000 IRA contribution, 25 grand of capital gains. I don't want to harvest $25,000 of capital losses. I only want to harvest about $10,500. Why is that? Well, if I look at my map here, once I get past $10,500, the other 95 is falling at a 0, right? So we don't want to blindly harvest capital losses. In this case, we want to offset only the portion of losses that's likely to fall into a 15% bracket. Of course, we're never going to be perfect at this, right? But blindly harvesting capital losses every time can be a real waste. Why? Because in this case, if we have 25 grand and we harvest 25 grand of capital losses, we're going to end up with 0, but we're going to miss out on $9,500 of capital loss that we could have used in a future year. It will not be carried forward because it'll offset gains for this year, but it's going to be offsetting capital gains that would have fallen in a 0% bracket. In other words, it's just wasted. That's an important concept. And the reason it's an important concept is because for our middle income clients that are unlikely to be in a situation where they're regularly going to have capital gains that fall into the 15% bracket, harvesting capital losses really isn't helpful. Instead, we should probably be harvesting capital gains. So let's just say that this was a situation where we had no realized capital gains. We didn't sell anything through the course of the year. Maybe it was all in ETFs. So we didn't have any pass-through gains from mutual funds. So we got no realized capital gains when we run that report in November. but we've got 100,000 of unrealized capital gains sitting in the account. Let's just say that was the situation. We definitely wouldn't want to harvest capital losses, even if we could. Instead, we might want to take some capital gain. We might want to sell a position. And effectively, what's going to happen is when we sell it, we're going to realize the gain. But it comes through at a 0% rate, and we can rebuy it immediately. We can rebuy it the same day. And when we rebuy it, we just got a free step up in basis. Now, when I later sell it, I'll have this new higher basis because I harvested some capital gains along the way at a 0% tax bracket. Conceptually, hopefully that makes sense. So we've got harvesting, we've got changing ordinary income in order to bring capital gains out of the taxable range. We've got harvesting capital losses to directly offset capital gains. And we've got harvesting capital gains to take advantage of a 0% tax bracket. Now, of course, these are techniques that are probably pretty common for your practice, but hopefully this is a little bit different way of visualizing them, both for a client and maybe for you, for identifying how much should we do of this technique or that technique in any given year before we potentially run into trouble, before we run into a 27% bracket we weren't expecting, or it's not really a bracket, it's really an effective marginal rate, or we run into a tax torpedo. Now, of course, there are also charitable techniques. These are really beyond the scope of this webinar, but charitable gifting of appreciated securities, qualified charitable distributions, donor advised funds. These are all techniques that work really hand in hand with the techniques that we went through today. Now, I know that I had 40 minutes today, and we also had a few minutes for question and answer, and I see a few have come in through the course of the presentation.